Well, hello everybody. Welcome to our Market Master series on our secondary indicator, the CCI, the Commodity Channel Index. This is kind of a fun indicator to help guide us or help us kind of get an idea of when we can enter a position is what I usually use it for, and what we'll be teaching here primarily is how to use it on entry. You can use them on exits. It's kind of neat, but understand, folks, it has to correlate with something else. So, as with all of our classes, guys, just make sure you know what you're doing before you do it. There's no indicator out there that's perfect every single time, but it can give you a statistical advantage and help with your probabilities if it's associated with others. So this is one we're actually going to stack on top of the most important thing in the world is price action and volume, right? So the CCI, a little bit about it here. It's a common tool for traders in identifying cyclical trends, not only in commodities but also equities and currencies. It measures the securities variation from a statistical mean. Now I'm going to bring this up 2 or 3 times, but basically what it does is it shows strength in direction. And what's really cool about the CCI is when you get a breakout or a breakdown, it's basing it off of a 20-day period is what this is based off of, and I'll get to that slide as well. You can set this 20, 30, 40, 50, 60 periods, whatever you want. The one that works the best is the 20 period. Now we're going to use it on a daily chart, so that would be a 20-day average. And it takes that mean, that average mean, and it measures moves up and down and gives this a ranking here of plus 100 for the up move or minus 100 for the down move. That becomes its statistical range, its mean. Anything above plus 100 or below negative 100 shows an increase in direction or strength outside of that mean. Let's get a little deeper into it, guys, because that's all this is. There's the formula for you nerds if you want to get into it. No, all joking aside, I mean, there's a lot of my engineers that like this stuff, but there's the calculation there. And it just takes an average of the 20 days here. So the Commodity Channel Index can help identify price reversals, price extremes, and trend strength. It's kind of neat because when these turn back from, let's say, below the negative 100 and get back into its range. And what's really cool about this, if you guys can see, there's a ghosted area here, and when you pull this up on any of your softwares, you'll see that. And this ghosted area is the negative 100 to plus 100. So when the CCI is inside of this ghosted area, between the 100 and the negative 100, it really doesn't give us too much of a read. It can show us movement up towards the plus 100 or down back to the negative 100, but it's only really good when it breaks those levels, right? So how do we use it? Well, just like that. It's really cool. You put it up on your chart. I use this a lot for day trading, but folks, I need you to know that you can put this on a longer term time frame. I was using it on a 15-minute chart, 30-minute chart, so on and so forth. Very common for day traders. Really cool to bring it further out, weekly charts, daily charts specifically, and using it for options trading as you get further on down the road into the options world. It's kind of nice to have that extra advantage to show confirmation of specific types of charts, or I should say chart patterns. So the normal range is between the 100 and the plus 100, like we were talking earlier, last slide. So if it's staying in there, it's not going to give us too much to go off. Now I'm going to go ahead and start teaching this as well. There's times when not to use this, and that's it. You can anticipate a move moving from up to down or down to up, but you cannot use it as a trigger. There's one other thing I'm going to say now, and I'm going to say it again later on. Price action must confirm the CCI. The CCI does not lead. Price leads the CCI. And here's the cool thing, folks. You've probably heard this a few times. Secondary indicators are secondary because primary indicators lead secondary indicators. Too often, people get into their, well, not just the CCI, but your stochastics and MACD and any sort of secondary indicator and preemptively get into it expecting it to confirm. You can't confirm without price, so price first. So let's go through these bullet points here, guys. Above 100 shows intensifying trend to the upside. Below 100 shows intensifying trend to the downside, right? If this is a mean revision, or I shouldn't say revision, but if this is a mean outsider measurement, it's going to show this is outside of its normal up move, or it's outside of its normal down move. What does that tell us? Breakout, breakdown. So increasing upward movement, decreasing downward movement within the range of negative 100 and plus 100. But the only thing that can do is just raise an eyebrow to where we take a look at the chart and say, as the CCI is rising towards the 100, is the chart or is the price moving towards resistance and could possibly break? This is great for breakouts, high base breakouts, low base breakdowns, all sorts of patterns in that source. So the default number, once again, I'll say it here. Here's a great slide for it. 20 period average is what this measures. You can extend this out. However, folks, you start to get slow reads or no reads at all. You put this out to a 50 period or a 60 period, you'll see that the CCI rarely crosses the plus or minus 100 marks. Now, is that a bad thing or a good thing? It's actually a good thing because you want to be able to identify an increase in volatility, because that's all this is, outside of a 20 period range, because unless you have some sort of a pattern developing over 50 or 60 days, you probably don't want to use a 50-60 period average. Or I'm saying days, but periods. Something a little tighter could give a lot more false signals. So if we had a 20 period, we went to a 10 period, I should say, or a 5 period, this thing would shoot up to plus 100 and then shoot right back down to negative 100 and so on and so forth. It couldn't smooth it out. So we try to find this happy medium, folks, and that's what we're going to refer to it as this sweet spot. Now, with everything in charting, everything in trading, and specifically when it comes to options, there's timeliness and accuracy. And so the sweet spot is when you want to give the highest probability the most often to where we can read something useful. Once again, shorter time frame, we're going to get a bunch of false signals. Too long of a time frame, we're going to miss out on a lot of great trades because none of them really would have confirmed. So we got to find this just right, if you will, the three bears syndrome, right? Goldilocks and the three bears. What's right? Now this takes, right off the bat, you guys can take what this is. Take the standard default. There's a reason why it's a default. It's because it tends to work across all time frames and all sorts of different types of traders. However, make it fit your style. Okay, so you got to find that balance between the accuracy and the time frame. And this is not only just with the CCI, but with all other secondary indicators. All right, guys. So the CCI is one of the better indicators to confirm entry points on symbols trading in basing patterns, buy-sell readings, right? Don't use it so much as an exit. Exits should be predetermined. Exits should be adjusted based on, support resistance or highs and lows. It's nice just to leave your targets and your exit points separate. This is primarily used for entry. So downward sloping, upward sloping gives you an idea of what we could expect, but make sure we don't jump into it until it's confirmed by what? The primary indicator, price, right? So here's an example, pretty cool stuff here. This is the CCI on a high base pattern. Well, it looks like an ascending triangle pattern that broke out and a high base, a little bit of both. So let's go through some of these, I believe. Yep, there we go. Cool. So here's a little bit of a high base breakout. So when the CCI breaks above the plus 100 on a symbol in a strong uptrend, what is that telling us? It's saying that, hey, over this last 20-day period move, this average 20 days, in this case we'll call it days, this move currently is stronger than the average. That's what it's saying. So there it is. It's confirming. We've got price. We want to make sure that it breaks above the resistance at the same time the CCI. And you could say not only did it at this point, but it carried through 1, 2, 3, 4, a few days. And look at the CCI continue to break above that plus 100 and stay up. So that's a really good indicator. Now, folks, right where this arrow is, we'd have to zoom into this, but it might be very, very close to, has the candle closed above or broken above the resistance high? That's what we're waiting for. So, this is all fine and dandy and exciting, but we need that confirmation of price as well. But that's a good example. Let's go further on down the chart. Here's another one here. Now, this only stayed for a little bit. It broke out, but you'd have to find out if this indeed confirmed to the point where it got you in. And if it did, that's fine. It did dip back down and consolidate, but it looked like, hey, in the long run, it worked out. One thing I'm going to add, since we're already here, folks, we're going to use this for entry, but I don't want you guys to use this for exiting or position management. Keep that in mind, guys. Management is going to be predetermined. It's going to be based on your plan, and it should have nothing to do with this indicator. You could use other types of oscillators if you want to. I would suggest just price action, support, and resistance. But once you get into the position, do not let the CCI talk you out of any position. Once it's in, it's in. Because this will, you can see, dip down below this area, break out again, so on and so forth. Let's move forward because I do think there's some more. Here's another great example. This broke out right through this area. Let's move out to this. Look at this, folks. That's a beautiful breakout. Now there's confirmation of a nice candlestick above the resistance area, increasing on the CCI. This is exactly what we want to see in correlation. Now, folks, we did find a nice uptrending stock. You put the CCI on, and it's never wrong. It's a secondary indicator. This will be a little bit lower. Actually, I say a little bit behind, but not by much. Not by much. Remember, we use this to get an anticipatory look at a chart. Confirmation is price action. I talked about the high base. Let's just briefly go over the ascending triangle pattern. Another beautiful pattern with this. This is all going to be momentum increasing or decreasing, so it's going to be breakouts, high base breakouts, ascending triangle patterns, double tops, things of that nature. So let's do the opposite. We're here, might as well do it. So low base, CCI breaks below the 100 on a symbol in a strong downtrend. It's confirmed at the breakdown point. A support of the recent low base pattern has broken. Let's get some examples here. First one, really nice. That's pretty obvious. That would have been hard to catch. It was a gap, but let alone, look, the CCI was right on the money. Let's get to something a little bit more realistic. Okay, good. This next one here, it did break below the 100. We did have confirmation of price breakdown, but if you take a look, it did rally back up. That doesn't matter because that is a good confirmation of a move lower. You can see that even though it did rally back up, depending on your management strategy, we would still be in this position, and look, it rolled over and it fell and probably hit a target later on. Or if you've got an options trade on this. Once again, do not let the CCI talk you right out of it. So you get into it based on the CCI confirmed by what, folks? Price action. Price action. I get in. The next day, it goes up. Oh, bummer. Doesn't make a difference. The trend is still intact. You're playing the trend. You're not playing that day. So make sure we keep those two very separate. Let's take a look at another example here. Here's another breakdown. This is great. It's a gap. It's hard to catch on the price, but you can see the CCI might have been showing us a little bit before. We do not enter, though, until the price confirms it gapped. Kind of a bummer. Here's one that's a little bit more relevant without a gap. So pretty good. Red candle there. The CCI was saying that, hey, look out. If this thing's about to break, you can see that the next day from this arrow, it did confirm a breakdown to the downside. That would have been a great entry as well. And I believe there is one more in here. There it is, right at the end. Another gap. But once again, I think you guys you're getting the idea. It's really cool to see these start to tip. And when you go out live, folks, and obviously once you get this class done, I really want you guys to go out there and take a look at this live, right? So go out and pull up any chart you want, see where it's done it in the past, and watch it going forward. Because it's easy to see in hindsight. But going forward, like take a look at the very end of this chart on the right. You can see it's actually doing it again, isn't it? So get used to it. See how slow it is. It's usually a little bit behind. Price action will confirm about the same time that the CCI is. So keep that in mind as you go. So when it fails miserably, that's a little great. It's funny. All right, completely worthless in a sideways trend, other than it confirms sideways, right? So if this thing is touching the 100 and coming back down and touching the negative 100, and any move as it goes towards it, towards the 100 to the upside or towards it to the 100, yes, we can see that, hey, it might be moving that way, but it is not a trigger. Okay, it has to be outside of that range. This is a volatility indicator. This is taking the mean of the last 20 periods and saying, we're outside of that. This is a big move to the upside, or here comes a big move to the downside. I should say here, not here comes, it's actually measuring it as it happens. So falling into the trap, and I said it a few slides ago and I told you I'd say it again, here it is. Falling into the trap that an oversold symbol can't fall anymore or overbought can't rise anymore. Now that's its own thing, but anticipating that it's going to break the 100, negative 100, anticipating it's going to go above the plus 100. Once it gets there, it's, oh geez, I've missed the move. It's just an indicator to let you know that, hey, we're outside of normal volatility, which to me says there's a lot of power behind what move it is, regardless of it's up or down. So trading the 100 or negative 100 points before the move happens, I just combined those two. Very common. You'll find that this indicator is so consistent and you get good at it, you're going to anticipate it. Don't do that. That's a big no-no, and it creates some really bad habits. All right, guys, so just to understand how to input the CCI in your chart settings, it's very easy. I'd say 99.9% of every software has it. Even free softwares, paid softwares. I know that Interactive Brokers has it. I know that Thinkorswim has it. They can be manipulated too. They're going to be standard at the 20, but you can extend that. You can shrink it. Play with it. Get out there and see what it looks like. I would suggest not deviating too far from that 20. So make sure the numbers that you use impact your matches or time frame. Start with that 20. If you're looking at a daily, it'll be 20 days. If you're looking at 15-minute candlesticks, it'll be 20 15-minute candlesticks. So it's going to be 20 units no matter what you're looking at. If you want to try 25 or 30, if you're a slow player, that's great. I wouldn't suggest going any shorter. And just from experience, guys, it's just going to give you so many falsehoods. It might just be more of a bother than a benefit. So only a confirmation to what is happening in the price action confirms the CCI. Backtest to see if it improves results. I'm going to tell you right now, you guys know my stance on backtesting. Of course it will. It will be 100% correct. Being able to read this as it happens, if you can do that, it's a good tool for you. If it's just a mess and you don't like it, you can set it aside. We teach these secondary indicator classes for a reason, guys. So you can have a choice of 1 or 2 or 3, or just to open your eyes, and there's thousands out there. But don't rely on them as a primary indicator. And if it doesn't work for you, you don't have to trade it. All right, guys, thank you so much for joining me. I appreciate you, and we're going to see you next time. Bye, everybody.